Good evening, ladies and gentlemen. This is Clueless 8, Frank. It's 7:17 p.m. Eastern Standard Time. This is a Sunday evening advanced coaching session, which will last roughly 60 to 90 minutes. Um, we have VIPS 1000. We have Mark Bader. We have Shawnee Shelley. We have Paras. We have Guru. Fantastic. Um, joining us, and we will shortly have Jones 31 joining us all the way from northern Canada. So can everyone has to just make sure that they can see the screen, hear the audio, and we're going to kick off.
Yes.
Okay, great. So what you great. So the way that the session's going to be set up, try to keep it simple and somewhat of a free form, so people will have a much give members a larger amount of time to address their questions and walk them through that and try to give as much of an intelligent and accurate answer as possible. And but initially, let me just start off by a couple of observations, which we all obviously know, but just to reiterate, we first of all we're going to be entering a very busy part of the year, and not to mention a very busy part of the month. We have a slew of earnings that's going to hit us starting tomorrow, Monday, October 19th, and keep in mind that October 19th is that infamous date in 1987, which still lives. Um, Brett, can you hear us?
We're back on water.
Shut up. Brett, can you just mute? Okay, good. So if you can just mute your phone, if you guys, if there's noise in the back, but as long as you can hear and see the screen, then you're halfway in the game. So we just had Brett Jones joined us. So anyway, October 19th, 1987 was the infamous crash where the market lost a quarter of its value. So you can rest assured they'll be talking about that quite a bit tomorrow on Monday. Now remember, that was called Black Monday, so you know, let's who knows? It's one of those crazy things. Sometimes these prophecies are self-fulfilling prophecies, right? And you never know what might happen. We do have some very critical numbers that are coming out of China um, in the next hour or so, hour and a half, 2 hours, and of course the markets will react to that. Futures right now, as we know, are just down slightly. They're just let me just put this out there. They're down about 50 cents, nothing big, and put it out there like that. We're pretty much right here right now. So, no biggie. We're not seeing any change, any discernible change out there. Let me see here. Okay, some people just need somebody has a microphone that's echoing back, so just make sure that you have it muted or whatever the case may be. All right, so a couple of quick observations here. Number one, coming at a very busy time, it's going to be extremely volatile. My opinions, my observations tell me it's not going to be as volatile as what we went through in August, but nowadays I expect pretty much anything to happen. Does it? Does it mean that we can always be fully prepared for it? No, it simply means that we can analyze the scenarios and not get completely mentally bent out of shape if that particular scenario takes place. That's the purpose of this particular session, to be prepared so we know where the potholes are, we know where the ditches are, we know if where the markets can fall off a cliff and where the markets can go. So that's pretty much what it is, because once we're mentally prepared, then we can handle the situations as we go along. Um, so that's it. Now, so we're going to stick to October. We're going to look towards the end of the year. We'll talk about that. So here are my general forecasts and where we came from. This chart has been a great navigation tool for me, and as you can clearly see here, it is starting to make a lot of sense. Of course, a lot of things in life make a lot of sense when you look back in hindsight, right? So while you're going through it, it just feels you know, the rainstorms are so hard, the thunderstorms, that it just doesn't make any sense. But then when the sky clears and you look at things, you're like, okay, that makes a lot of sense. So let's see what would normally in a perfect world, which is certainly not, make sense. We have a large pattern symmetry in motion, a massive dragon bullish formation, or a W formation as I call it. And for the bulls, obviously this is very exciting. Um, the inflection points on this type of massive macro formations are very defined. This was the Fed reversal right there that I keep on showing, and we have basically, after multiple attempts, actually probably like 3 or 4 times, as you can clearly see, we have broken out of it. So at this point, the next engagement, logical engagement, is where I have shown a few times. I simply drew a downtrend line from the highs up here, and the next level of engagement is in that 2050 area or so, right there. Right there. Now here's a couple of charting is a subjective game because everyone charts their own way, and a significant amount of charting is based on your own cognitive bias, what you think the world or the markets might do. Now, whether one is bullish or bearish, one can technically chart to perfection, but does it always play out in the real world exactly that way? No. However, I just want to point out that the thing that really messes up charting is the random, unpredictable, in many cases, intraday volatility that occurs from nowhere, to be honest with you. Case in point, and everything is a learning experience, we all know that. Case in point was this sell-off. Now, what was this sell-off for? Walmart,
Walmart,
right?
yeah.
It was Walmart. Now, I feel that what the Walmart management said, Kerry, are you in?
Yeah.
Okay, great. So we're talking, Kerry, join in. We have Kerry here coming in. So we're talking about, we're trying to analyze and learn a little bit about what happened within the past couple of weeks, if not the past week, and we're talking about the forecasting part, so we're a little bit more prepared going into next week. And then we're going to entertain a whole bunch of questions, and we'll get a little bit deeper. And I'm going to show you a couple of earnings that I'm looking at, and I think that'll be real actionable stuff, going into the week. So all of a sudden we get this big fat sell-off all day long, consistent selling, robotic selling that takes everything down just because of Walmart. That's the market. Walmart is a significant portion of the market. The data was the metrics were that Walmart sell-off was almost just a sell-off on Walmart that day being down 10%, which really has never happened. Okay, in one day. 10% of Walmart. It's like taking down Apple 10% in one day, which has happened almost. Okay, so the thing is that you affect everything. That was half the valuation of the S&P 500. That's what they were saying. I'm like, wow, something to really give a lot of credence to. However, I felt, for reasons that I posted clearly, that nothing was fundamentally damaged, and they were still within the range that we were traveling in, which is basically this channel. We are in this upward channel. Did it feel good? No. Did it help me manage my trades and what subsequently happened the day after, which I did not expect to happen, mind you? But did it help me manage my trades and make some significant profits on this total V-shaped move? Total V-shaped move with a bull flag right there at the end, which I showed in minute detail on TradingView, which I'm going to show again tonight. Yes, it certainly did. Now, is it possible, which I clearly showed, that we would have had a breakdown of the channel and fallen harder? I mean, really hard, and tested the downtrend line right here again at around the 1936, 1944 level? It sure could have happened. but that's just the world that we have to live in. If we are going to, if we're going to be in the middle of the financial market. So volatility, what I'm getting at, is intense. So these type of things, when they happen, I'm going to zoom in a little bit more. Look at this. I mean, it's what I try to learn from, and every day after the markets, I mean, I'll just sit there in many cases for a good solid hour and just stare at the charts, because the longer you look at something, the better off, it starts to talk to you. And one thing I've noticed repeatedly, and I've addressed this question to answer this to many members, is the pattern symmetry is just so intense. Hey, Nia, are you in? Nia, can you hear us?
I can hear you. Can you hear me?
Yeah, you're a little bit faint, but yes, we can. We're talking about, just obviously the market. So 1 second here, Nia. All right. So what I'm getting at is the pattern symmetries are really, like, for a visual trader. That's what I try to really. A good component of my work is visual. And let's say somebody knew nothing about technical analysis and just looked at things in a visual fashion and said, you know what, I think the patterns are going to do what they're doing, and this is what I think is going to happen. And you know what, they probably have a pretty high probability of being right without knowing anything about what's happening in the market, just by looking at the visual representation, because the visual pattern symmetries are so linear in many cases. Look at this. Then you have a bull flag. I mean, you have a consolidation channel, which I called it a consolidation channel several times that day and the previous day, and then a breakout, also known as a bull flag. So what happens is you look at these things like this, and you can actually discern what's going on. So my thought process is that the reason why these things are happening, and this is not the first time I've seen this. I mean, I've seen pattern symmetry, and I've shown pattern symmetry for years now, is because the machines are in complete control, and which machines are very algorithmically precise. Okay, our behavioral patterns are pretty precise too. I mean, we all like to believe that we're changing our character and stuff. That's all garbage. We don't. We're basically the same people. If we're really rotten people, in general, we will be rotten people when we're, a couple of years down the road. And that's a fact. That's behavioral dynamics. We'd love to say, oh no, I've really changed. I've become, a very soft-hearted person and stuff. Not true. People, if they're rotten at the core, are generally rotten, and it'll come out. So behavioral patterns also manifest themselves in charts. So I try to specialize on it. Like to look at myself, like to look at the markets and say, okay, this is what I'm seeing. So saying all that, the randomness that occurs for traders especially, okay, the randomness that occurs for traders especially is primarily because of all these machine-driven volatility patterns. And these patterns, of course, looking back in 2020, in hindsight, they're like, wow. So what I try to do is try to take a naked chart, which is basically the candle charts. Okay, let me see here. Settings, drawings. 1 second. Don't want to delete all the drawings, but I know that there's a way here to hide them. 1 second. I think that's more on Thinkorswim. So anyway, so let me see. This is S&P. 1 second. I'm going to show you the same chart without my lines. I guess the chart is if I draw the lines out. Nah, forget it, because if I completely delete these lines, then it'll also go off on the other side. 1 second. All right, so let me go back to the same chart. I'll figure this out one point, because okay, so if you imagine this chart naked without any lines, just a naked chart, yeah, you can see the patterns. What you won't have is the directional flow or the GPS guidance, because I've taken the time and whatever expertise that I have and whatever I think in drawing all the patterns over it. I'm sure there are auto-generated programs out there which draw similar type of lines. Generally speaking, every technical analyst, you guys follow, you see some great people out there on StockTwits, people outside in the trading world who draw so many different types of charts. And they're brilliant people out there, believe me when I tell you. But everyone to its own. And the way I look at it is the lines that I draw just work for me. And I'm going to stick to it. I'm not going to reinvent the wheel. And a lot of my technical drawings on top of these, whether it be equity or index patterns, are very accurate. So that's what I'm going to focus on tonight, and see what I think is going on. A couple of things here. Okay, number one, this is a breakaway. This is a bull flag. There's no question about it. So the first level of attack or a movement is going to be here. So you're talking about 2040 right there. Now, if this hadn't happened, if this reversal hadn't happened, okay, and I kept on saying 2030, 2040, I didn't make these numbers up. What I'm looking at is it was going to attack this major resistance level here. And if it took out this resistance level, honestly speaking, there is very little resistance from here up to where we completely broke down from, which is here. Just want people to understand that. When we started to fall here, there was no, when we started to fall here, imagine this is a pattern that we're following right now. This, ladies and gentlemen, is going to happen. No doubt in my mind. No doubt in my mind. What time frame it's going to happen, I don't exactly know. Venkat, you there?
Yeah, Globe.
Okay, so you got to jump in and just follow. We're talking about that. So this pattern, which is really the pattern completion at around the 2100, 2110 level, has an 80 to 90% probability of happening based on what we are seeing in front of us right now. So what we are going to try to do here, I'm going to try to do here to help everyone, is that so they're not amazed by, they're not like completely thrown overboard by whatever's coming our way this week going into the end of the month, is draw out some scenarios which will show us how we can get there and also the downside scenario of why it won't get there. But this is the complete pattern completion. Up to is at 2100. That's pretty much where we started to break down from. 2100, 2107. So let me get all these, erase all the drawings here. So at this point, the easiest way to look at it is, number one, this downtrend line here. Let me suppress all these internals here for now. Keep in mind, this is an hourly chart. It's pretty clean. Here's the downtrend line. It's touched two of the most important critical inflection points. Okay, the massive resistance, to be honest with you. These are massive resistance. Okay, right here and right here. A lot of institutional and retail money was lost right at those levels. Okay, so obviously that's what resistance is, at the point where, where people want to, what is resistance? Resistance in simplest terms is at a level where there's a lot of selling. Why is there a lot of selling? Because majority of the time, people are recovering what they lost. So you buy something at 4, it goes down to 1, goes back to 4, bang. 4 is a resistance, because at that point, you're made whole. You're like, that's it, I recovered my money. Thank God, I'm getting out of town. So that's where the churning happens on the resistance level. There's always a behavioral reason behind why something is called resistance. It doesn't just appear from nowhere. So once you break out of that resistance, obviously that's when you take off. Just the way something happens here. And then what happens? It comes and retests it. It did that. Comes and retests it. It did that on Friday, right? So Friday was a classic case where, just from the sense of it, I was pretty sure that we would come down and test this level here, which would be perfect. I said that before in the morning pre-market aim report. The test the 34 and the 50 line, test the downtrend line. It would be a perfect scenario. Nothing wrong with that. Instead of making 2-3 points on those S&P puts, could have made like 6 or 7, but even then it was good. So it didn't do that. There was way too much strength. Keep in mind that one of the most important things I kept on talking about for weeks was that this particular monthly options expiration was going to be far more important, and more importantly, monthly options expiration Fridays generally tend to have a bullish bias for many different technical reasons. And this one was more so because a significant amount of institutional traders and retail traders were short, or they were not participating on the forward side, on the bullish side. They were just too blown out of the water with everything going on with Walmart, all this big sell-off. They were just like, you know what? And that shows up in many different studies, and I've posted a few of those out there. You guys know that. Credit Suisse came out with a pretty extensive report which showed that more than 90% of retail investors are so scared and confused. They just don't want, they're just like, forget it. And I've been saying this for months now. They won't buy here. They won't buy here. And they certainly won't buy here. Why? Simple. It's like the same old days, you know, when I was in the wealth management business. Oh man, this is it. This is going to be the big bad wolf, you know. No. It doesn't matter. It didn't matter who Mr. Jones, you know, the famous last term all Wall Streeters use. So Mr. Jones, no, this is a significant bottom. This should definitely hold for now. You got to get into it. No, I can't, you know. So what do? They get in maybe here. Seriously, they get in here because they're starting to feel comfortable. Comfort is the worst term ever in trading and investing. I mean it. I know it personally. You start to feel comfortable, you start to feel complacent, you're going to get hit on the head. And you know, as traders, we know that too. We start to get comfortable with the trade. It's, you know, so discomfort, I have for years tried to make discomfort my friend. This is like a bad ad for those adult diapers. I'm just kidding. But the bottom line is that from a behavioral standpoint, this was what they bought. So the market went up a little bit. They're like, yeah, looking good. And then comes Walmart. What was it? Wednesday, right? Red Wednesday. Always be cautious of Wednesdays, I'll tell you that. So especially if it's on a primary trend, things are going higher. If you have some nice fat profits and stuff, scale down on Tuesday hard. Wednesday has a 90% probability of being a red day. And we've seen this. Anyway, so here comes Wednesday. So what is mom and pop and whatever, whoever that even traders get in, they're like, man, this is too much. I'm out of Dodge. That's it. I'm going to wait for a better opportune time. Well, guess what the better opportune time was? Right at the bottom of this rising channel. Right there. I said that report that night. I kept it purposely short. I said nothing changed. Because honestly, nothing changed. Yes, I was taking a risk in saying that. So what? I'm in the business of forecasting. Forecasting is a business of assessing risk. Is it possible? Like I said, we would have broke down below the channel? Sure it have. But there were a lot of internals telling me that we were too oversold too fast. And then I looked at a lot of the macro stuff and I said, is this Walmart thing really something that can damage the overall picture? Because honestly, Walmart thing was a misstep and a miscalculation on the part of the management. Walmart management. Anyway. We're going to get into that, but so I said, okay, time to basically scale in and buy a couple of cheap things and not go too crazy, and worked out fantastic. So this is what happens. So the Credit Suisse report basically said the same thing, that they won't buy here. They won't buy here because what's the term? Whoop. Market's way too high. Market's way too high. Everything's out there. You know, the global economy is slowing down. Everyone's a frigging global economic guru. If something crept in my mind this afternoon when I was out with my wife. I look back at the years that I've been doing this and look back at what an ultimate, and something just swept through my head. I don't know. I'll tell you guys, the best time, and this is the bullish view, mind you, okay? Because I'm a tactical bear too. But listen to this carefully, please. The best times ever in the markets to buy is when you have the largest concentration of negative forecast or negative what do you call it, earnings forecast from Wall Street analysts. There is a negative 5%. Look it up. Negative 5% consensus that the fourth quarter numbers going into the fourth quarter that companies reporting right now will show in that there will be roughly negative 5% growth on the S&P 500. Guys, let me just point out something here. Markets are not to be bought when companies doing well. By that time, the stocks are gone. I mean, really gone. You and me both know that. The best time to buy are when the estimates and the forecast overall by the so-called pundits from Wall Street and the media are uber negative. And in general, they are. There is only maybe 2 or 3 top-notch analysts who are actually bullish on the market. That lady, Savita Subramaniam, one of the best minds in the business. You have Tom Lee, who's also fantastic. Yes, it's too bullish at times. So what? He's been right. He started his own company. And then you have like maybe 2 or 3 other people. The general consensus from the media, from StockTwits, from all these, is, oh my God, no, we're falling into a deep, dark hole. So let me give you the bullish view for a minute here. If this pattern works out, and forget mom and pop, they're not in the picture. They'll come in when all of a sudden, it's like the end of December or November, mid-November, when we're all the way up here or more. They'll be all excited. They'll be calling up their mutual fund guys and say, hey, listen, take that, all the money I put in the money market account. Let's move into that, what's that, the emerging market. Put me in the Turkish fund. Put me in the Korean fund right before the next slap. Guaranteed, guys. Okay? Guaranteed. So the point is that this rolling ball of complete miscalculation by the investor community is giving us some very solid opportunities to make money now. So if things go the way it goes, and this is a technical pattern, let me clear out this chart, then, ladies and gentlemen, we will miraculously, honestly, land up here. And then possibly do another pull down. And then climb up and make a new high by the end of the year. The way things are going right now, I'm just letting you know. And I'll give you a fundamental basis why I'm saying this. I'm not saying it's going to happen. I'm just saying this possibility. That we're going to make new highs this year. And people will be like, holy shit. I can't even say the words, okay? They'll be like, man, I don't believe this crap. I can't believe I didn't buy it. I mean, you know what? Traders, and I know how traders think. Because I'm a trader, I know. Okay? How many times are you going to cry? Really, like cry inside the head because you did not make that 50,000, 100,000, 10,000, 5,000, whatever the case may be, just because you didn't act. Guys and girls, I don't need to tell you that. It's happened to me too. I mean, I should be loaded up to my gills with 60% of my capital, which to me is a very high number, trading capital, shoved into these plays that we're doing, shoved into the S&Ps. But no, I'm also trading tactically cautious. That's costing me money. I'm doing very well, mind you, but it's costing me money. How is it costing me money? It's costing me money because I'm not making that money. How many times have I seen these calls and these, and even on these type of pullbacks, technical pullbacks based on stochastics and all that stuff that I talk about, instead of doing 20, 30 or more contracts, I'm doing smaller amounts, single digits. They're still doing great because what are they doing? Those things are ramping up 300-400%. So what's happening, guys, is not a function, is a direct function of volatility. These machines have put us into a hole mentally, up and down, mind you. Has it not happened that we've been short and the market's gone long and it just won't come down? And it's like, come on, man, I need that sell-off because I'm burning a hole in my in that position. Absolutely. So both ways. So it's the volatility algos have really done a number on us. I'm telling you right now. And unless you really accept that, you're not going to hit the big runs in this market. I'm telling you right now. And they've done such a terrible number, emotional damage. It's like those CSI shows or Criminal Minds, right? Great shows. They've totally, excuse my French, effed with your head. And you keep on missing trades all the time. And you're making a little bit, yeah, sure, but you're missing it. So enough of the behavioral finance part. So at this point, if you look at this channel here, definitively a positive channel. The one thing I talked about the other day is that, and remember, these are multiple inverse head and shoulders, multiple what do you call dragon bullish patterns. These are the macro patterns. Then you have small patterns like this. You have little bull flags like this. So what gives? So this is almost a perfect scenario to jam in and buy the market on tactical dips and really buy it hard. Now, so on a swing basis, we're getting to 2100 because that's the top of this channel. The other way you can draw this, if you really want to get a little technical, is you have I'd drawn this line weeks ago, so I'm going to push it out a little bit more, extend it. So you have another level of resistance that's around 2070. You have a short-term resistance right here at 2040, which is the upper end of the Bollinger. And notice one thing about these Bollingers, and and believe me, I respect them. When these Bollingers are getting stretched out, that means there's a big breadth thrust going on. That's a combination of massive short squeezes and new money entering the market, new institutional money entering the market, because they want to make the last run between now and the end of the year really fruitful, because these money managers can't go with go and end the year down minus 10% because nobody's going to put money in mutual funds anymore. I actually posted a tweet that everyone should read, which talks about the fact that you can be your own king. You don't need a mutual fund manager to tell you what the heck to do, or some hedge fund to tell you that they're going to make money for you. It says it was put there at, and I do want everyone to read that because it was an article on the Wall Street Journal. It says new book dives into Wall Street's shady dealings. It says Wall Street often puts the individual investor to sleep, then picks his or her pockets, says the author of a new book. I love it. And so I put my line saying, take control of your finances. So this book talks about the fact, and it happens in every business, okay? It's not like shady stuff, honestly. They create all these Fidelities of the world, Vanguard, and all this stuff. They are creating this level of confusion and complexity. So the individual investor's like, oh man, I don't really understand this. Let me give it to a pro. Guys, you're all pros. And these minute $40 sessions are worth more to you and other people and other things that you learn and follow, and of course, and learn on your own, are far more important to giving your mutual fund manager 3% of your capital every regardless of anything he does every year. So that's, you definitely read that piece here, okay? Because that's going to piss off a lot of people in the industry. And I'm not saying people are dumb in this. They're very smart people. But what I ever wonder is why are they so wrong? 90% of the time, I gave up answering their question. So I'll just leave it at that. So bottom line is we have a serious channel here. A lot of lines are meeting. First level of major resistance comes into play here, which is around 2044. If we do get what would be a perfect scenario for us, it would be a nice fat pullback from the 20 to 40 level. Where did we close at? We closed S&P at 2033. So let's say we move up a little bit more, we push higher, engage this zone. And of course, I keep on putting up this chart, so just track it. Engage this zone, make a sharp move down to the bottom of the channel, which also happens to be the critical support at 2023. Why is it critical support? Because that was the Fed breakdown. Okay. the sudden waterfall reversal, bearish engulfing that started this big sell-off, right? So major critical support level here. But slipping through support is standard procedure for the machines. They want to make sure that you get enough fear in you because a certain support broke to get the hell out of your thing. I don't do that. I'm not saying I don't do that all the time. If I really believe that things are really going to, there's some other stuff that I don't quite understand and uncontrollable, and the internals are showing that way, I'll be out of that trade. But in general, I don't like being out of a trade during a primary trend. That's why I dollar cost average down, both on the long side and the short side. So whatever the bias is at that point, it's not to say that I'm just going to completely let it evaporate, but the primary trend is still up. So this might slip, and if it does slip, it will come to the bottom of this and test this downtrend line again, this downtrend line from here. Okay, 2 points of contact, 1, 2, and that would be around 2004. And all of a sudden they'll be like, oh my God, 2004, we just gave back 300 points. That's roughly 300 points from here, okay? One S&P point is roughly 7 or 8 Dow points. Just remember that. So the media is going to be like, oh, here comes that big October sell-off. All that stuff. And so what might happen is, worst case scenario, if the primary trend is intact, is that we'll come and test these Bollingers at 1995 and these acceleration bands right here at 1988. So somewhere around 1990, let's call it, it might do this. What does this create? Another multiple that we have seen, dragon bullish formation. Look at that. Like that. And then all of a sudden you wake up and they're like, oh my God, this market's like finished. And the next morning the market futures are up 300. And you're like, what? Well, how many times have you seen that? Again, the crying, the internal voice in the head starts crying, man, why did I go out of this? I can't believe I did this again. So this pattern would be fantastic, because you know why? Because if we do get to 1990 on the SPX, things are going to start to get reasonably nicely, fatly cheap. And I like that, because right now some things are just, whoa, they're hot. And they're hot because they want to go higher. That's it. They want to go higher. Amazon, $600. I mean, what's $30 on Amazon right now? It can happen in 2 seconds. Priceline, we're going to try to look at a few stocks, Priceline probably wants to go back to the highs. What was the Priceline high? 1450? Somewhere around there? That's 100 points from here, right? You can do that. It's only $1,000 stock plus, $1,000 plus stock still trading on the technology side, on the large cap technology side, right? All the other ones have split. So this would be a great pattern, by the way, guys. And if we can get this week, depending on the internal, depending on the background of why that happened, this would be a pretty screaming big fat buy. The other scenario is that they won't let the bears in. They won't let anybody in. And I keep on saying that. The algos don't want anybody in before they take off. That's what they did on Friday. That's what they do every single time. So the other scenario is they break out here and engage this, have a minor pullback of 20 points. This is the 20-point pullback, by the way. 2072, 2058, 12-point pullback, 12 to 15. And then people are like, oh, man, I'm really hoping for a nice fat pullback. No, bang, up here. 2100, in my opinion, is definitively a great shorting opportunity. But by saying that, I might have shot myself in the foot, because other people might be thinking that 2100, wow. Now, here's another thing that's going on. Very important. I noticed this on Friday. The big, boring industrial stocks, the GEs, the reversal on Schlumberger, the reversal on, Microsoft in a pretty big breakout level here. Stocks that we don't normally trade in on it, because we're always going after the sexy ones that move around 20 points, right? Guess what? The big, boring industrials and the big, boring techs are on the move. Guys, those are the generals and the boring generals. If those things start moving, this market can go a lot higher. We don't need the help of frigging Netflix. Hold on. That's my wild cat. Loves the monitors, right? So sorry. So we don't need Netflix, and we don't need Priceline. Schlumberger, which I bought a bunch of it, and I don't normally trade Schlumberger, but I don't know whether oil's bottomed or not. That's not my business, okay? But at least the mega companies in the oil sector, especially the ones from a tactical level, which are good for 6, 7, 8 points. SLB, I showed that chart definitively, can can move the market up another 500, 600 points. Look at GE. No one's really talked about it that much. I mean, yeah, in the media they talked about it a bit, but think about the trading community. They don't really trade GE. GE had their fastest growing quarter. Yes, their numbers and stuff were lower. I'm not a GE expert, but the stock had one of their biggest up days in their history. So that's what I'm saying. Institutional money likes to rotate from sector to sector. They don't completely leave the market. They only completely leave the market if there is a massive credit crisis. And then they sit there in treasury bonds, or they sit in cash accounts and things like that. So institutional money is basically rotating out and saying, listen, we'll punish the ones who don't deliver. They punished Walmart. They punished Walmart hard. Those fat cats on Walmart. Walmart executives get paid a lot. You know, take your private jet to Bentonville, Arkansas. You know where Walmart is in their private runway. Those are fat cats. Don't let their bad-looking suits fool you. Those guys make crap loads of money. They got punished big time, and the market will punish them more. So they'll take that money and move into managements and areas where they will find growth, where they think the management is doing the right thing. All right, that's what's going to happen. So you have, excuse me one second, I have to sneeze. My apologies. Can everyone still hear me clearly?
Yes.
Okay, good. I'm going to wrap up soon. A couple of important things, and we'll open up the floor, and we'll, address all the questions. So bottom line is that when we start to see, going back to the original thesis, something I learned a long time ago. You want to buy into sometimes, and I think this is one of those times. You want to buy into some bad guidance. Okay. And when you say bad guidance, because what companies do, companies are very smart. You think managements are stupid? You think they just come up with random numbers for earnings? They make sure they're doing, sometimes what companies do, like I think Schlumberger did, they have a kitchen sink quarter. In other words, they throw the kitchen sink, the baby, the bad dishes, everything out the window. And they just say what the worst things out so that the market digests that and says, okay, maybe we can't get any better than that. What they call it trough earnings. Like it's as low as you can get. Believe me, companies have trough earnings. Unless the global economy is on a one-way cataclysmic fall down, which I don't believe. Companies will basically just say, okay, this is our worst quarter. Here, take it. Do whatever you want with it. And so companies like Schlumberger and stuff, I think, did that. Okay, and so the smart money bought those $4 lows. They were down like $4 at one point. At the end of the day, they were only down like less than $1. So the thing is that a lot of companies will do that, guys. Okay, they will basically say, let me just tell them like whatever they want to hear, the outside world. So we have to be selective on the ones we're looking at. And unless global growth is completely stalled, which I don't believe, okay, then the market will rise. Now it's hard to believe that the market can rise higher from here, but believe me, it can, and I can show that in charts. And I'm just showing you on the recent ones. So this is what's going on, okay? So if the industrials start moving, see you later. We could have all these texts and stuff that we play down $4, $5, $6 that day, and the market's still up 300 points. Just remember that, because the big cap industrials are powerful, and GE showed the way on Friday. And there's others who will be coming along the way. So net, I think what's going to happen is by the time earnings season, earnings reporting calendar ends, which is basically what, the second week in November, right? Second week in November is because a lot of companies come out with earnings. I mean, earnings report in the first week of November, but sometime by the second week of November, it starts to die down. We should be up here, if not up here. This is probably the year-end target. But then you know what happens in December, right? You get the big tax sell-off. A lot of people adjusting things for tax reasons and stuff. So people wait around till December, and bang, they hit December really hard. And then by the second half of December, they take it up again. Just the way last year. So saying all that, this is the negative scenario. Let me point out the bear picture here. Very important that we know all sides of the picture. So this is clear. And there's another line that I can draw, which is very important. And please watch. Is this. This was a pretty cataclysmic pivotal low that got bought. So when I draw a parallel line, I am drawing this here. Bingo. So this channel, I'll change the color so people can see it. And please watch. Let me check. Let me take this. Okay. So it stands out from the other lines. This is all about pattern recognition, by the way. This is not about traditional technical analysis. This is pattern recognition. So here we have a large channel that the market would have normally traveled in if it wanted to go down, right? Let me explain this to you guys. The market was kind of traveling, and then if things hadn't happened like that, the big blowout, because these big sovereign wealth funds were blowing up because of oil. They had to sell, which propagated a slew of selling across the world, billions of dollars. You know, the Norwegian fund, then a couple of big hedge funds here. Anyway, so that's out of the way. We covered that quite a bit. It would have gone like this. It would have gone like that, okay? Slowly trending down. And who knows? I mean, if it kept on trending down like that, we'd be going down. But it didn't happen. This happened along the way. So what is a critical support here? 1974, ladies and gentlemen. And you know the big technicians talk about 1970. Bingo. So many different ways you can actually arrive at the same area where the market has serious support. And that support, ladies and gentlemen, is at the lower end of this channel, and it's like around. It's like around. I sound like a bad Californian teenager. It's around 1970 S&P. Below 1970 S&P, you can rest assured that we will visit these lovely zones down here. Okay, below 1970. Below 1970, you have different levels of support. Of course, you have 1932, which is bad support. It won't hold. It's going to drop. Lots of, minor supports here, but it's going to test this. So VIPS had asked a question, good one, a couple of, like I think week or so. I said, do you expect that we could have a move like that? I said, yes, we can. A triple bottom would be, in my opinion, a screaming buy. I mean, you just have to remember, you want to have screaming buys, not scream and cry because you didn't buy. Seriously. You want to hold your nose, scream and say, that's it, I'm buying those 20 contracts right there. I'm gonna hold on because this, I think, was going to swing out and it's going to do a pattern symmetry based on. I've called that. I called that before. I said, yeah, you could start. You guys, this could be huge, and it turned out to be huge. Am I going to lie and say, oh no, I really bought like $200,000 worth of options down here. Right now they're 1.6 million. I wish. But did I make some significant amounts along the way? Absolutely. But the next time that type of stuff happens, and you have the ability to do that, then use maximum aggression to buy. Because one way or the other, in between keeping you up a couple of nights because they keep on doing these zigzags, the market is again going to climb. Maybe not to this level, but at least climb. Remember, the biggest money is made in the first 24 to 48 hours. We all know that. Do we always follow it? No. What do we wait for? Confirmation? By the time the confirmation comes, the market's already here. And that's the truth. So is it possible that we come down and test 1860 again? Absolutely. So 1970 S&P, ladies and gentlemen, has to be watched. Or, has to be watched, not like sitting there doing nothing, but it has to be that we have to see this. And of course, my job is to alert people as intelligently as possible that that is a possibility. So this line is important, the 2009 level or so, engaging the 50 and the 34. Which, let me cover this for a quick, for important reason. Let me see. This line here, the 50 and the 34, which I give a lot of weighting to, is moving beautifully higher. Just the way it moved beautifully lower, well, guess what it's doing? It moved sideways, shook everybody out, took everybody out. Nobody wants to be in the market. And guess what? Or too short. Now it's moving, snaking its way higher. Like that. All right? So the point is that we don't want the standard deviation or the market to move too fast, too furious away from the 50 and the 34-day moving average. That's when you start to see technical deviation, and that's when you start to see real overbought conditions. When or when you move too far away. So it's moved far away a little bit. So I think once it gets up here, the 2050 level, we should have a decent pullback so that we keep on engaging this upwardly rising 50 and the 34. Now, why is it so important for some people who are listening to these type of stuff for the first time? It's important because it helps you manage your trade, and it helps you to freak out less. Helps me to freak out less. And the less I freak out, the more money I make, regardless of the fact that I could be down for 24 hours on a couple of trades. So what? It's the end result that matters, not what somebody thinks of why I bought it and it's down and they're like, oh, I know it's down now, I'm getting out. It's fine, go do what you need to do. I'm going to stick to my discipline of what I think. And if I'm more right than wrong, I'm golden. I can't be right like every single time, but on macro forecasts, my forecasts are extremely accurate, both on the long and the short side. So I'll leave it at that. Short term over 5-15-minute basis, yeah, you could be right. Great. Intraday basis, sure. But there are two ways to look at it. And this is something very important that I want everyone to understand this. You can skin the cat many ways, right? That's a terrible thing to say. We got 3 beautiful cats in the house. But whoever made that up, dead cat bounce, really was a cat hater, I think, and all that stuff. So here's the point here, that there are 2 ways to make money. One way to make money is trying to navigate every little twist and turn in the market. Every little twist and turn. Oh, I want to catch this. I want to catch this. Oh, yeah, I caught this. Yeah, I didn't catch this. I caught this. What it does eventually, it's a lot of tactical management. I love it. I'm a daily warrior as well as a multi-week warrior and a monthly warrior, whatever you call it. So I can handle it. But people who can't handle it, don't try to catch every twist and turn. I know it's hard because the patterns can change within 5 hours. And then you're looking at the chart. He said, whoa, Frank said it's going higher, but now it's down here. He's saying that it might go lower here. So I'm just going to always keep on putting out what I think is the truth. So like I repeat again, the different ways to make money. So one way to do it is to say, listen, and I'm not telling you what you need to do. I'm just saying, is to say, okay, I bought it here. I know the market's going to get up towards at least the 2070 level. I know these levels are important. So why keep on selling out and trying to catch that exact bottom? Because you won't be able to do that for a simple reason. This might happen overnight, this type of pullback. And unless you're a futures trader, staying up middle of the night, you're not going to catch it. So what do? You try to chase it when the bounce happens in the morning and you buy it here, but then you only have this much to go before the pullback happens again. So my thought process is that on certain longs, if you feel that that the market is going to end up by the end of October, which I think is going to be a positive month, then buy a small amount. You're down, let's say you buy the S&P calls and stuff, you're down like 60%, 70%. You're like, okay, then buy a little bit more there. Now, the reason I say it works is because it worked for me very, very, very well. You don't get 1,000 point gainers by feeling comfortable. And you don't need to throw your whole kitty in there. You get 1,000, 2,000% gainers, which are humongous numbers. And there's another thing I want to shoot out to everybody. We get so immunized by listening to, oh, I just did 200% on that trade. Guys, go try saying that to somebody out in the real world. They'll be like, what? They can't get 2 frigging percent. And you're saying you put in $1,000 or you put in a couple hundred or you put in 10,000 and you made 200%? They'd be like, wow. So what happens with us traders is we become like immunized. Like, oh, I just made 20%, it's nothing. It's time for us to stop thinking like that. This is real money. You don't always have to make 200% or 100%. So what I'm getting at is that if you are, so the one way to make money is basically you can scale in, and then as the trends reverse, you sell out and hit those tactical points and you get out of Dodge. You don't necessarily need to short here, because remember one thing, very important here. In a market which has a primary trend, which is clearly higher right now, unless we break these critical levels, right? The primary trend is still higher. Don't be a hero by staying short too long. I didn't make that up. The gurus will tell you that. Stick with the primary trend. And if the primary trend is not your friend, then you are going to be playing with fire. That is exactly why the markets and the shorts are getting killed. Now, once you get up to levels where things truly get overbought, which are these type of levels here, this type of level here, and of course this type of level, at that point you can possibly put out some nice intraday swing, not intraday, intra-week, couple of days swing shorts out there in the market. But do not keep on fighting the primary trend in the market. Seriously, this is a damn good looking chart. And if charts were the only thing in the world, then I would literally go berserk on buying positions unheard of. When I knew less about technical analysis, I should just follow my charts, and I did less analysis on everything. This was a couple of years ago. I made more money than I ever did because I was fearless. And now I'm still fearless, but I'm always watching over my shoulders because of all these machines that constantly keep on. And I know, and now I study charts more. So what happens when you know something more? You get more cautious. You're not reckless anymore, really reckless. Remember, this is a type of market where really reckless traders have actually have made some serious money. You can make a fortune and say, I'm not trading for the next 3 years. I'm serious, but you have to be reckless. You have to be aggressive. If you really want to be cautious in a volatility-driven market and you don't have the luxury of following all these type of very, very patterned, very, very, very accurate charts, and you want to play the real cautious part, welcome to some really bad news. You will make no money in the market. I'm serious. This is a market driven by machines, driven by pure volatility. So if it's pure volatility, how do you expect calm waves? There are no calm waves. Every wave is violent. You just have to know how to ride it. It's true. Every wave is violent, up or down. Is there anything calm about these waves? No. Upside waves are violent. You're holding on to your shorts. You're like, oh my God, I can't take this anymore. And you're trying to short more. And then the market kills you more. And then right when you give in, it pulls back. So you have to know the levels. So that's what I'm getting at. That being cautious is fine. Of course I'm cautious, many times. But being uber conservative about trading in this type of environment ain't going to give you anything. Just wake up to that fact, guys and ladies and gentlemen. Okay, it's not going to give you anything. It does not mean you have to be completely reckless, but you need to have an element of risk built in. If you're always waiting for confirmations and solid, that's it, this is the time, I'm gonna wait for that moment of truth. Well, these are the moments of truth, real moments of truth. Then these were beautiful moments of truth right there. These levels. This wasn't a moment of truth. This was a tactical buy. We didn't know if it was going to go lower or higher, but things showed that it was going to, that nothing really was damaged. So it's a different story. So the moments of truth you can do, but there are otherwise no moments of truth. So so let's take a quick look at the daily. And the daily, and I'm going to show you this here. Oh man, this is scary. If I was net really like short, I'd be really. I would have a multi-year subscription to diapers through Amazon or Loves or whatever. This is a powerful chart, guys. Not mine. I'm talking the market. I'm just drawing my lines over it. This is a breakaway candles. So the next level of attack is right there, 2050. Next level of attack is right here. But overall, when you look at this pattern, all the market is trying to do, and it's always done that one with the other. This was a vertical drop, 90-degree drop, straight down. Panic, capitulation. This was a capitulative drop not seen in a long time. Capitulative drops always need to be bought, unless the world is ending tomorrow. So now what they're trying to do, just so you know, they're trying to this angle is, can somebody tell me, if this was a 90-degree drop, it really was. What is this ascent? What is what's the
45.
Thank you. Exactly. 45 we like. We don't like 90. If this one like this, I hate it. Why? Because I bought a little here, and then I'm not going to keep. I'm like, 90-degree angles are horrible. So if this was the case, I would definitively go ultimate short at this level. But that's not what the market's doing. The market's moving in a pretty civilized manner. And of course, civilized manners can turn into rude behavior if we break below these channels, below 1970. So we just want you to understand that this is a very civilized channel. And the upper end of the channel, this is obviously the daily chart. The upper end of this channel is the confluence of these lines here. So at this point, things get a little bit tight. I mean, rocky. Nothing bad, rocky. Overbought conditions can stay overbought for weeks. So this is a daily chart. I don't want to go over that. Pretty clean. It wants to go back and test this and see whether or not it survives up here. It's going to get there. In the meantime, this line has to be watched, and that's around 1984. Lower end of the channel is 1974. Now, let's take a look at the weekly. And I notice this on Thinkorswim also. Look at the weekly chart here. Okay? And these are powerful candles. Look at that reversal candle. Now, when you look at the weekly, you can actually see what a real reversal candle looks like. This was a real reversal candle. Once you see it, this was a reversal candle, but they had to do massive margin selling because there was so much damage. What was it, 20 trillion or something that was lost from the global markets on this drop? So obviously, the money that was made in this had to go in to settle a significant amount of institutional margin calls. Significant amount. So once you get these reversal candles, look what's going on here. Does this mean that every candle is going to be green like that? No. It simply means that 2050, that's another 20 points. Not much, like 120 points. It's not much at all, actually, before it hits some resistance, real resistance. The other way to look at it is it wants to get and retest on the weekly. And I'll show this to you on the Thinkorswim chart. Retest the 50 and the 34. So I was looking at this. 1 second. weekly can't get any more prettier than this, guys. All right, you don't need me to read this chart. This chart is saying it wants to kiss and test and possibly break out and complete this pattern somewhere around 2100. This pattern, ladies and gentlemen, I've said this so many times in the years. Sometimes I haven't followed it myself, but I'm following it. This cup, ladies and gentlemen, is going to be made whole. And this candle is clearly telling you all these patterns, these candlestick patterns are telling you that it wants to engage initially the 50 and the 34. And this really ugly drop, well, guess what? That ugly drop is manifesting itself here. It's not happening in one day because we're moving in a 45-degree angle instead of a 90-degree straight down, which is good. So this is pretty clear in the weekly where the markets want to go. Now, is it possible? Anything is possible that we are going to basically just do this. One second. Is it possible we're going to do this? There's still little room to move. And then completely give in? Absolutely. I just showed you that before. No problem, certainly can happen. But at least for now, this is what it's showing. Remember, these are acceleration bands and Bollinger Bands. This light blue line, the white line up here. We got to the bottom of it. We fell out of it. We are in it right now. So the upper end of the Bollingers, can they be matched? Yeah, we sure can. So internals, we're not even overbought on the weekly. You know what that means to me? With that gaping mouth on the stochastics? That's like a cobra saying, I want to eat bear cubs. I'm serious. That's what it's saying. It says, come on, short me big time. I'll show you what I'll do to you. I'm serious. That's exactly what the stochastics are saying. Kind of a crazy analogy, but it's true. It doesn't mean that it can just suddenly turn around, but I'm showing you what it's showing right now, just the way it showed here, back in October of 2014. If you followed the stochastics in October 2014, and I did very well that time too, okay? This is what happened, and we made new highs. I repeat again, a $20,000 investment in the S&P 500 or other options would have generated to you close to 600,000 to 700,000, if not more, just a few weeks later. Can you guys do it? Absolutely. I think anybody can do it. It's a question of, are we mentally ready to do it? That's a different story. The McClellan oscillator is starting to get overbought on the weekly. And of course, when it gets up here towards the 42 level, it's a danger sign. That means time for a nice pullback. And I showed that to you guys. That once we hit the 50 and the 34, we probably create a handle on this cup, and that handle could come and test the 1970 level again. And so I watch the McClellan very closely when I'm watching the weekly charts. So that is in, this is a daily. So the daily is basically telling me that 2050 is the upper end of the Bollinger. There's a lot of resistance at this level. And if we overshoot and go to 2100, well, there's a lot of resistance at that level. So at this point in time, the best way you can chart this, if you want to know where the market's going, you do this. Watch. You can do it from here. You can do it from here. If you do it from here, it goes too high, so forget that. I'm just going to draw like that. So 2050, 2060, ladies and gentlemen, is your, it is more of a rising wedge right there. Or you can draw it like this. Take a duplicate line. Oh, come on, man. Trend line 3. What the hell am I doing? 1 second. Let me just get this line here, and then I'm going to take questions. Trend line 3, yeah. So Is it possible that we can come to 1960? That's how many points? That's 70 points, right? 70 times 8. So that's another 500 to 600 Dow point as a pullback. Yes, it is. That's on a, but it's, but that's a pretty extreme situation. It can happen, just so you know. And it's still a buy because all the market's going to be doing is testing the 34-day moving average again. So that sums up what the picture is right now over the short term. And I know many of you have been tracking the. Bear with me. I'm just going to sign in on the other side. Just want to show that chart quickly because I show that a lot, and that's been a fantastic trading vehicle too. While I'm doing this, let me cover a quick thing on China. VIPS is somebody excellent. He has a lot of deep insight into China. He was one of the early investors in VIPS, the stock itself. So he does a lot of work in China. I'll tell you one thing here. I don't know what the Chinese can say, but I don't think they are going to, and I repeat this, I think the worst in their markets for China are over for now till the first part of next year. Now, my thesis has been validated by by one of the best Shanghai analysts. I think he was at J.P. Morgan. I'll get the name. Who basically thinks that we're going to have a 25% rally between now and the end of the year, and then the market's going to correct hard the first part of next year. And I say, good for you. And look at what the Chinese stocks are doing. I mean, I didn't even need to tell you. They are just on fire, and they got so much room to move. So if you think China is going to be the next bear's friend, I think it's a little late, guys, because they're not stupid. They're not going to constantly print crappy numbers. I mean, why doesn't anyone come in and say, hey, the Chinese really have been very honest with their numbers lately, because all they keep on delivering are crappy numbers. Because they wanted to show the world that they're not going to massage their numbers anymore. They're not going to manufacture the numbers. But just by doing that, okay, just by doing that, they are playing behavioral game theory. Let me explain this to you how. This is political game theory. They basically told the world, we're not going to keep on printing good numbers. We're going to show you what the bad numbers look like. But we're also going to show you at the same time what our economy and markets can do, despite the fact that we have some bad numbers and we have slowing down and all that stuff. So all of a sudden, they gain credibility in the eyes of the real players in the world, not you and me and us peanuts. I hope you guys understand what I'm saying. It's very, very high level thinking. So that's what they did. So the next set of numbers, even if they come out crappy, I think I can, with the high degree level of probability, tell you that you're not going to see a crash in the Shanghai market or here or in the Chinese stocks, aside from some pullbacks, because they are positioning themselves to make sure that they become a real credible player in the world of finance, where transparency is important, regardless of the fact that most things are not transparent. Okay, so that's what they're setting themselves up. They want to be part, of the world reserve currency system, the yuan. So for that to happen, they have to follow a very strict set of guidelines by the IMF. Want to read up on it? Just Google it. IMF guidelines for the Chinese reserve currency. So if and when they become a reserve currency, all of a sudden they get the VIP, the real VIP stamp on their markets. And their markets are going to trade much more, in semblance with what the global markets trade at. So what I'm getting at in simple terms, in simple English, the China card that they played is brilliant. Second thing, China is moving from a very large export-orientated economy to a consumer-driven economy. The Chinese Services Index is far more important right now than their overall PMI and numbers, because the Chinese industrial production is important to get a reflection of how the world is doing, because after all, they are the world's factories still. But what's most important is what are the Chinese doing with their monies? And the Chinese government, this is a huge experiment. You know, you're talking about 1.5 billion people or not more. I'm not talking about Denmark with 1 million people. There are more people in Brooklyn than there are in Denmark. So, okay. So all joking aside, their experiment, in my opinion, will work. The Chinese consumer, it's a behavioral change, is saying, okay, we're trying to feel good. Let's go and spend some more money. So if you really want to talk about what's going to happen 5 years from now, this bull market ain't dead yet. Okay, just letting you know that. And neither is China. Don't believe me? Go take a trip to Asia and see what's going on there. Despite everything, we sit here in this cocoon called the United States of America, a lovely, comfortable place where we're not getting shot every time we're walking out the door. Well, it depends on where you live, but still. The point is that in general, we don't. Neighbors are not like, you know, coming and shooting you out because you're from a different color or creed. All right. So the point is that we live in a level of stability where we have become stupid. And our stupidity makes us, every time something happens, we're like, oh, the world is ending. The world is not ending, ladies and gentlemen. So that's all I got to say. This particular chart on the trading view is a beautiful. I love this platform, and it's very clear, very clear. Somebody said, yeah, you like it because the background's white. I said, yeah, maybe, you know. I mean, this looks very clean. It's very clean. So at this point, every little tick, when I call in the shots between this and the bar charts, which are the algo HFT charts, my intraday moves are literally becoming far more precise than they ever have been. I highly suggest you guys use this. Everybody who's listening to this needs to use one platform at least that matches with the platforms that I use. So what does this tell you? This is telling you this just by following this, you can manage your trades, guys. All right. And when I start to implement the live trading rooms, I'm going to be showing a lot of the charts in real time. And you'll hopefully be able to react quicker because you'll be seeing the same things I'm seeing. And I obviously try to do that in the form of static charts that I put out there. But live trading charts in a live trading room are pretty cool stuff. But I need to do it right. That's why it's taking a little bit longer. So this one is so this is it. This band, Drew, once it broke out and it didn't break down, I said, that's it. I'm getting out of Dodge. You got this little drip here. That's it. Got another 2 points on the puts. I'm out. I don't go crazy long, but on the S&P calls, I mean. But this is, here's a gap fill. Gap fill. Showed this many times. We're in the gap fill. So what's the next level of contact? The upwardly rising Bollinger Band right there. What is that? That's 204.40.09. Breakdown below the channel at 202.86, let's say, means we're going to come and test this trading band. This is a beautiful trading band. Can everyone see this? It's a beautiful trading band. You can buy the bottom of this band and trade it up. Of course, you have to watch this, and you have to watch other stuff too. So this trading band is telling me that we are most probably max move would be upper max move over the, like at the open or something tomorrow, or maybe early, is we are going to get to the top of the band, 204 or so. So that's very nice if you have SPX calls. It opens up really big. And then a little bit of like negative news and all that stuff. We fall out of this channel. Remember, this is an important channel, right? Same channel that I showed on the other platform. If you fall out of it, it's going to be a sudden drop. The 50 and the 34 can't hold that drop. All of a sudden, everyone's scared again, big time. Maybe it's Target this time telling us, they're doing stupid things. No, I'm just kidding. I don't know. So, and then you come down, and then again, this acts as major support. Below this line comes in. So this is a beautiful chart. Not mine, but my lines are real big, solid guidance. This is real solid technical guidance on what you can do. So when I put this up there and I do the periscopes time to time, as you know, just track it. And engagement with the 50 and the 34. I love the fact that the standard deviation here is less than 1 overall. The more visually, this is how you read it. If you move crazy away, and it can last for a couple of days, crazy away from the 50 and the 34, somewhere along the line, you are going to engage with the mean, reversion to the mean. Now remember another thing here. The further you fall, like we did here, this standard deviation was almost -7. I mean, unheard of. -7, deadly. Imagine we get a -7 standard deviation from the 50, and standard deviation simply means the distance, from the standard deviation distance from the 50 and the 34, which is basically your highway that the stock market should be traveling in. So imagine a let's say, for example, a +5 deviation from here. We're gonna go straight up. Can it happen? Believe me, it can. This happened. Why can't this happen? So as long as we are tracking the 50 and the 34, then with our heads remain reasonably calm. If we move too further away from it, then it becomes either a buying opportunity or a shorting opportunity. But breaking of the 50 and the 34 on the 1 hour, we have to watch this very carefully. If it breaks this and does not hold this trading band, then you can rest assured that we're going to fall rather quickly. You can make some very decent money on that trade. But the trick is, you don't know whether or not it's going to hold or drop. The algos don't make it that easy. They'll just make you, have you guessing and keep on moving around like this, and then boom, maybe at 3:30, they'll drop it, or at 3:30 they'll go like this. So that's where I come in. So that's your market forecast, guys, and so the patterns are in place. And I'm going to open it up for questions. It's 8:40. So feel free to go ahead and ask, and I'll put in my 2 cents.
Frank, can you hear me?
Yes, I can hear you. Go ahead, sir.
Hey, this is VIPS.
Yes.
On stock trades and others, I see like a lot of indicators being followed, like which is a tick trend, Nicene, NAMO, this and that.
Yeah.
Which for most of the, I don't understand those terms.
Yes.
Clearly, but I'm wondering, do you also follow them, or
yes, I look at them.
Rely on
No, no, I just don't rely on stores. I look at the NASI, I look at the BPA Next, which is stocks above the 50-day moving average, which was at the lowest levels. Highest percentage of stocks were below the 50-day moving average, just in the past, within the past month or so. So there are 2 ways to look at that. No, those are very important indicators to give you a level of where most of the companies are trading at. The NYMO, for example, is a very clean looking thing. The New York Stock Exchange McClellan Oscillator. That's also another one that they use it. And the best place to look at a whole bunch of them from some very serious people is on stock charts. As you know, on stock charts you can 1 second here. On stock charts you can look at all those different indicators, and what it simply does, it gives you an idea of the overall health of the overall health or level of where the markets, where the companies are. So this, for example, I'm pulling it out from this side. So this is free, dollar NYMO, right? Stockcharts.com.
Yeah.
Okay, so bear with me 1 second. Okay, sir. All right. So here we are. So this one is basically, remember, the underlying, those are all derivative charts of the same underlying asset, right? So the main underlying asset is stocks, equities, and all those are derived from there. So depends on, looking at the overall picture is very good. But what I try to do is look at purely because of the machine trading that happens in the market, I try to look as clearly into the charts which are giving me an indication of of whether machines think that they should take the market higher or lower. The ones that you're talking about are terrific, and I look at them too. And that's whether it's NASI or whether it's what's the other one, BPNX, which is basically stocks above the 50-day moving average or below the 50-day moving average. So all those are reflected in the same type of charts that I'm showing you right now. For example, the McClellan oscillator. So McClellan oscillator right now is telling you that companies in general are going to, that the market in general is far from overbought. Once you hit the lower end of the oscillator or you slip completely out of it, like we did on August 24th, right, you get a huge reversal bounce. Here, we had a positive divergence. I talked about this in my older stuff. And right now, it's telling me that this upper end of the Bollinger just keeps on screaming higher. So does this mean that it has to go all the way here? No, but it's at least giving me an idea that stocks are bouncing off from lower. I'm going to pull up the NASI here. The stocks are bouncing off some deep oversold levels and still have room to move higher. So one second. So this NASI, for example, is the Nasdaq summation index. It's very similar to it's very similar to all the other stuff I look at, and also very similar to the McClellan oscillator. So when I look at this chart, for example, and this is, you mentioned this one, it's telling me, look at what happened here. I mean, this was humongous. I mean, this was just unheard of. Minus 879. Whoa. Created a massive double bottom. Now, remember when we came down back at the end of September to test the lows almost? I'm sure everyone remembers that. Look what happened to the NASI. Okay? It actually printed a higher low. So by looking at this chart alone, not to mention my stuff, and this is all tied in with stochastics and everything, is by looking at this chart, it told you, and I mentioned it too many times, that we have a positive divergence here. Because we printed the same low levels, give or take a few points, but look what happened to the underlying pressure, the internals. The internals made a higher low. Right there, it was a go for it, market going higher signal. So all of these are tied in with the same underlying asset class, which is equities. And they are just showing you in many different formats what it is. So this chart will never look completely different than any of the other technical charts that I keep on showing, because it's following the same underlying asset class. So right now, for example, on the Nasdaq summation index, we want to know what a definitive definition is. Just Google it, Investopedia, other people, you can find it. Right now, it's telling you we are overbought. Okay, great. So does that mean you short the hell out of the market? No, it simply means we can stay overbought a bit, because this overbought condition gets really overbought a little bit higher, more like around 90, because it's an RSI. There's an old saying in the business, buy below 30. I mean, this is a 30-70 RSI. A lot of them are 80-20. So there's an old saying in the business saying you buy below 20 and you sell above 80. In this particular case, you buy below 30. Look at that. These are swing trades, they work beautifully. And then you buy and then you sell over 90, over 70. Well, we are over 70 right now, 78. But till it gets, like I said, we are in for a quick 200-300 point correction, in my opinion, after we hit that slight mark, like I told you, like we have another 120 points to go, another 300 in my opinion, another 300 point, on a pullback to reset things. So this NASI is, like I said, that's another word. So those are all complementary to everything that we're doing. So that's the answer to your question.
Yeah, great, thanks.
Yeah.
Can I ask one more?
Of course.
Sometimes, like in the intraday, like I see that you hold both sides of the trade, like say puts and calls. Why not like basically exit one and then be on one side of it? Or just want to get some clarity as to how.
No, that's a very good question. The reason I do that, because I don't know what's going to happen in the next 15 minutes. Right here, for example, right? This was a breakdown. I'm like trying to amplify this. Right there. That was right here. Okay. by the way, this timing I got to fix. The timing that you see at the bottom is actually Pacific time. So when it says 17:15 down here, when I'm doing this, it's actually 3 hours behind. It's actually 2:15. So right here, for example, let me walk people through this. It's very important. It's a very good question, Radna. So here we have, on many of my different charts, on my bar charts, on my other stuff, it's looking like I'm going to get a nice little pullback, which is going to come and engage with the mid Bollinger and hopefully with the 34. So I'm remaining short. Then look what happens right after that. Right after that. So if my point is very simple here, if this trend just followed what it normally should be doing, which is like that, and then bounce from here, perfect. I stay on a unidirectional trade. But the reason we have such intense volatility algos is the reason why I stay on both sides of the trade. But because I stayed on both sides of the trades, this worked out really well. So that's what I'm trying to say, is there is the volatility intraday, especially, and even intra-week, is so intense that if there is a monodirectional trade like that, fine, but it's not like that. It halfway through it decides to go the other way. So if I stayed in a monodirectional trade and stayed short, regardless of anything, maybe I'm going to be right on Monday, but in the meantime, they're going to blow me out and take a decent chunk of my profits, which I could have had by being on both sides of the trades. So that's the reason sometimes, not all the time, sometimes I stay on both sides of the trades. So this way, the way I look at it is this. I'm looking at the net result of that pair trade. So it's like an arbitrage, okay? So I got the longs, I got the calls and the puts. Now, if I'm starting to see a real breakdown, which it certainly looked like here, by the way, and if you look at the internals, the market looked like it wanted to come down nicely. Look, this should have gone like this, but no. It went like this, and then just went like this. So because of these volatility algos in play in the market, I tend to cover myself so that I can still take that nice little quick 2-3 points on the S&P puts on this side. Watch this, because one thing I learned a long time ago, it doesn't matter what I want. I really have to be a little bit fast in determining what the market wants to do for that day or for that week. So and nowadays weekly forecasts are quite difficult because of the volatility. But let's say intraday. So right when I saw this turn, all out of Dodge, I took my profits and I ran out. So that's the only answer. See, my goal is very simple. I want to make this clear to everyone. I want to make money and I want others to make money. So in order for me to do that, I will be, in many cases, given where we are right now with the markets and where we have been, given the machines that drive the market, be prepared for sudden changes, because my job is to be a very fast messenger of what I see and what I predict. And I cannot tell you that all of a sudden everything is looking all fantastic at at around 12 noon, and then this is the Walmart sell-off, by the way. Look, so if somebody was in a directional trade like that, so they're looking really good, and then comes the Walmart conference. Nobody even knew they were having that frigging press conference. Okay, and next thing you know, the whole market sells off 300 points. So that's the only honest answer that I can give you. I try to be unidirectional, and so in many cases I have been. If I do see a sustained trend where I can make money on that unidirectional trend, because I'll drag your example, okay? As somebody who keeps a close eye on the market and stuff. You were very bullish on the market in the morning. Your original thesis was actually correct, but somewhere early on, as you started to see the pullback, you actually made yourself a 1.5, 2 points in the UVXY, and you were not feeling good. The latter part of the day, market not only took out those highs, it went higher. So right there is a primal example of why it is so difficult these days to remain completely on one side of the trade or another, and all of us have to go with that. And like I said, at certain levels, your short bias can remain short, and I think that's more at these points where I believe the market will pull back nicely, 200-300 points. So that's the answer to your question on that. Yeah.
Great, thanks.
Yeah. Anyone else?
Yes.
Go ahead.
My question is, it's very similar to what the gentleman just asked. On October 9th, the charts are showing that my position was overbought. The stochastics were showing overbought, but yet you were certain the market was going higher, and it did, even though there was a red doji at the top.
Yeah. Okay. October 9th. Let me pull it up. 1 second.
I don't understand how you could have been so accurate.
October 9th. Okay. So let's pull up
Did I miss
October
my
9th.
internal somewhere?
Here. This is October 9th. This is 11 o'clock. And then you have it pulled back, right? This is our hourly chart. So we got you got three candles here, right? Three
Yes,
candles. Now, I can't remember. What was it, a Friday? It was a Friday, right? October 9th. And then we turned here at 2 o'clock. Well, let me let you into a secret. I don't actually know exactly what, why was I so sure? Because my other chart, which is going to be part of the live trading room, which is because by looking at the swing charts on or freestockchart.com, it doesn't tell us anything. This can be a flag, and I'm sure there was other background noise out there which I felt like, so this could have been a flag like this, right? Where you would come down and test this support, which would be 1999, which would be beautiful on the short side, right? And then we turned at 2007, 2008. So just to refresh my memory, one of the ways I do it is I watch for fast intraday. Everything is fast, so I can't even say what's not fast these days. But for intraday reversals, let me look for October 9th here with you. October 9th.
I was using the daily chart at that time too, so sorry.
1 second. October 9th. Yeah, it's tough to follow the daily charts on this. You got to follow the hourly. Okay, so this was October 9th. No, where is October 9th? Hold on. Pointer. Oh, October 9th, right here. Okay. So let me tell you guys a couple of things here. This is pure like trade management on the technical side. We hit the lower. First of all, we have a stair stepping. Get ready for this, guys. Okay. So this is powerful. You got the big sell-off. Okay. You got the big sell-off. And then watch these Darvas. These are the Darvas boxes. Everyone knows the Darvas boxes by now, right? Okay.
Yes.
When you see a Darvas box move up, look at the stair step it's doing. Walmart sell-off. Darvas will probably go like this. So first of all, primary trend is up, number one. So that itself lends credibility to the fact that the forces want to get the market higher. Number two, we are looking at the Darvas. We're hitting the lower end of the Darvas here. When is the 9th? Right there. And I'm seeing a reversal, despite the fact that the stochastics are pointing down. Okay, so I'm looking at that too. The third thing I'm looking at, so if I completely rely on the stochastics, then the trade wouldn't have worked. So I'm looking at the stochastics, so I'm giving it some weighting. Everything has to be given some weighting, so that it's not like 100% reliable. No indicator is 100% reliable, obviously. So that's number two. Number three, my bar charts, which are the ones which I say algo HFT. All right. So those charts were also giving me a signal, a reversal signal off the bat on what was going on. So that must have been the reason why I changed color, because the fact is that I'm looking at multiple screens to make a determination of whether or not on that particular instance, the stochastics are going to be the determination whether or not the market's going down, or whether there are other factors in play which will move the markets higher. So saying all that, let's take a look at the 1 hour here and look for the 9th. Oh, we already saw that. So the 9th, yeah, I just show the 9th was this was the 6th. Oh, that was the 9th. So the turn was at around 1:30, 13:30, yeah, like 1:30 in the afternoon. So it's a tough call, but honestly, like I said, we did get that sell-off, just so you know. The next day we did get that sell-off and the reset, but that was obviously with the Walmart thing. But the previous day, on the 10th we got the sell-off. Was it the 10th? Or 9th was, yeah.
I mean, I made money from my mistake, and I also made money on the upside. I'm just curious.
Yeah.
How
So
you
that,
get it so accurate? It was so impressive.
yeah, I appreciate that, and it's primarily because I rely on my bar charts. Okay, Charlie. I rely, Shawnee. I rely on the bar charts. I rely on the TOS and the background noise that I'm filtering, which brings me to a very important point here. Just keep in mind, I am not a pure chartist, and I've said this before. People know me. They know me. They've told. I know that. There are guys out there who are rocket scientists when it comes to chart. Yet when it comes to head-to-head performance, I'll beat them hands down. Because all they're looking at is charts. If charts told you the whole frigging story, in the old days it did. Do you know why? Because the machines didn't control the market and there was a small cabal of technical analysts, famous ones. Name some of them, Ralph Acampora type ones, okay? Louis Yamada and all these great people who formed the basis of traditional technical analysis. There's a few group of people watching a lot of technical signals. The rest of them were not. Now, everybody's a technical guru. So you have to take other things into account. What do I see when I look into StockTwits? A lot of people, if we stay above the 50-day for 3 days, we're going to go here. So are they not looking at anything else? Are they not looking at all these other multifaceted things that I'm looking at? Bollinger's, acceleration bands, standard deviations, stochastics, McClellan oscillator. Are they just relying on moving averages? And that's all I see out there. I'm not saying I don't respect them. They're great. They draw some nice lines and stuff. But it doesn't do anything. Because the 2 minutes later, the whole picture changes. So what I'm getting at is that you really have to think outside the box. And traditional technical analysts, in my opinion, suck. I really do in this market. And that's why they've been so wrong. So wrong on every one of the calls in the macro calls in the market. And then when they're wrong, they say, well, you'll see what happens. Well, great. So what do you want me to do? Stay poor for the 2 weeks that you were dead wrong and the 2 years that you were dead wrong, or since 2009 for 6 years that you were dead wrong? I don't really get it. I really don't get it.
I do have another question for you.
Sure.
On your vortex indicator and acceleration bands, are you only using the weekly and daily charts for those indicators, or do you actually use the hourly?
No, I use hourly too. With the vortex, remember, just because an indicator is showing a deviation, it does not mean it's going to happen that same day. Just remember that. Even if it's a positive deviation, Shawnee, it might take 2 or 3 days to develop. How many times have I come across as, told you guys, right? That the macro deviation, for example, when we made a higher low on the stochastics, on the NASI, like VIP has brought up, okay, in the picture, you could see that there was a positive deviation because the internals were showing less selling pressure, except the prices came and tested those ugly levels, right?
Yes.
Right there was a signal. So it didn't mean it worked out the same day. It can work out different days. If you look at the hourly on the SPYs, we're definitively overbought. Look at where we are on the vortex here. Does that mean that the vortex can go lower here? It can go to minus, look on the right-hand side. It can go to 0.48, right? There. So what I'm saying is this is what's going to, in my opinion, what's going to happen. This is what people hopefully follow me for. We're going to rally into Tuesday, and we're going to have an ugly Wednesday. How do you like that? It's going to happen. All right? Tuesday is going to be a reversal day down off the 2050 level or so, in my opinion. If we get a real sell-off tomorrow, futures are down 4.5 points right now. This is nothing. And what futures are down right now means nothing too in the morning. But if we get a real ugly sell-off Monday or Tuesday, buy with hands down, and we're going to be fine for because by that time we would have absorbed all the resets. If we keep on pushing higher, don't go overboard with longs. Tactically trade, but by Tuesday by Tuesday afternoon we should have a reversal. And Wednesday will be another one of those ugly reset days. That's my opinion. And then we'll crawl up. Remember one thing here. I'll give you a calendar dates, and you guys might want to write this down. To 19th, Monday. the last 5 days of the trading month are normally bullish. Why? Window dressing. They're going to make October shine. Unless something really dramatic happens out there, they're going to make October shine. You know why? Because there were least amount of people in the market in October. They all left town in August, and they're not back yet. They'll all come back in the last 10% of the move. Believe me when I tell you. So here's the calendar dates, guys, okay? We got 19, 20, 21st. Next week, starting the 26th, ladies and gentlemen, we should get a real push in the market starting the 27th, which is a Tuesday. A real strong push that ends the month October 31st on a positive note. That will happen through earnings. That'll happen through price line going down 50, up 100, all kinds of stuff. Okay? So the bottom line is that next week, this coming week, in my opinion, is going to be a reset week somewhat. Once we hit those marks, or even if we don't hit it, I think next week they're going to bring things down a bit. This coming week I'm talking about. They're going to bring things down a bit, especially the high, fast moving, you know, the big cap, the fast moving, what do you call it? High momentum stocks, the betas, the biotechs, the techs. They'll probably bring some of them down a bit. Of course, there's selective ones, you know, which don't really care. So they'll bring them down a bit, and like a slingshot, they'll buy the same crap next week, starting Tuesday. And that is my opinion. And I think that's what's going to happen. And that's always what they do. They bring out the best ones down, 15, 20 bucks. Everybody's just scared. They don't want to get in, and then they go up 30 bucks from there. It's happened so many times. I mean, come on. That's what they do. The machines do that. And the fund managers love it. Why wouldn't they love it? If they can buy Amazon down at 530 instead of chasing it at 570. While the rest of the world is like, oh my God, you know, they're finished. That's it. They want cheaper prices. Most of the market is manipulated, in my opinion. They're manipulated by machines, and they're manipulated by large funds. Not necessarily mutual funds, but hedge funds. Mutual funds are more like traditional when they operate in the market. Hedge funds are complete bandits. Complete bandits. They have no morals, and they don't give a whatever. Okay? They'll go in and out of a position. And like another thing, one of the few last things I'll tell you. When you're trading in the intraday market, you're basically trading against machines and hedge funds which are running the machines. Just remember that. There are companies like Virtue Financial which basically are just simply running machines. That's it. Their algo machines are going haywire. Then there are hedge funds which use algorithmic programs to trade the market. So you wonder why you can't have a unidirectional bet certain times of the day in the market? It's because you're day trading against some very powerful forces. And yet we are still winning in most cases. So got to think about that for a minute here. So that's the answer to your question.
One last question, please, and I'm done.
Yeah, go ahead.
Links to all your recordings, so I can review this information again and again.
Yes.
I received your link the last time, but it malfunctioned, but I did find the information I was looking for. Is it possible to get a permanent link
Yes.
to these recordings?
Yes. What I'm doing is simply this, is I was putting out for a limited time all these videos out there, okay? Now, one thing I found to be somewhat unfair is there are people who are putting in a few 2 cents in order to participate in these very intense discussions about the market and stuff, which are really, truly, in my opinion, very constructive and beneficial for me and for other people. So why should I keep on giving it out for free to people who don't want to even step one step forward? So that's the reason why I locked it. I put it out there, but what happens is it stays locked. Now, in order for me to unlock that, I just have to send you, what I have to add is a customer list of people who are in there so you can always access it. Now, when you got that, so that's the way it's working. So yes, in answer to your question, it'll always be available to you because you'd always be part of the group that is that has the permission to view the private, not unlisted, but the private videos. You know, you see a lock sign sometimes like this.
Yes.
1 second. So that lock sign simply means that is only available to, like the lock signs like this. You know, it's only available to people who were involved in that particular session. You know what I'm saying? So yes, I'll make sure that that list is fully added in there, and people can go from there. So everyone who is part of the coaching sessions will have their links, have their email addresses in there, so that not only do they get automatically notified, they also have full access to that video, because after all, they paid for it and they participated in it. So yes.
Yeah, that's a fair point. Can I ask one more question?
Of course, go ahead. And then, yeah.
If you can spend a minute or two on how you manage the trade on Netflix. I know like when we are doing the earnings.
Yeah,
trades,
the Netflix calls were obviously a loss. I had a few, so that was, that went down the chute.
No, but you managed the trade very beautifully, right? I think
like
you
what?
basically ended up buying at lows around 95 and
yes, that was simply because I bought
recovered the losses. So that's managing the trade is what I liked,
Yeah,
yeah.
I mean, I can explain to a certain degree because it is difficult. Let's just put this. Here's Netflix, right? And so when I saw the stock pop down that evening, and it was very volatile. I mean, this doesn't do justice to what it was doing. It was this, I believe. Let me see here. Wednesday, like this, right? So right around here, I see a massive reversal candle. It's actually quite easy. If you're using Thinkorswim, because that's what I use for my after hours trades,
yes,
it's like golden. So what I did was I lumped in and I bought a reasonably decent amount of shares. I mean, it's a $90 stock. It's not, you're not talking a $900 stock, right? So I went in and I bought a reasonable amount. Let me just put it this way. And I immediately saw it shoot up. This created a bull flag here. One second. This created a bull flag. I'm going to draw this out for you. So I didn't buy it here. I mean, I started to move up. This confirmed me that the trend, the reversal was on. So what I generally do in after hours type of trade. So my average cost was around $96. And I'm going to basically monitor it for a stop loss of 2 points. Or 3 points, depending on the size that I get. Now at 96, I don't lump in with my whole thing. Let's say I want to buy 2,000 shares. All right. Let's say I want to buy 2,000 shares. And so 2,000 shares, and after market things are very fast. They take in real fast. You put the limit out there, gone. There's always fluid buyers in these type of things. So I'm not going to put all the 2,000 right there. So I'm going to put 1,000 here or 500 here. And as I'm starting to see these candles, to me, this is like, whoa, fantastic. So those calls that I had, they were, if I remember correctly, they were like $8, $9 calls, right? Yeah, as far as I can remember. Yes. So I'm doing a quick mental math, like, okay, I got a bunch of those calls here. What can I do here? Because chances are that I'm going to bet that if the stock even stays down $2, like you correctly point out, VIPS, these are option killers in many cases where they will hold the stock down $2 for no reason, and the premiums on both sides get thrown out, right? So I'm trying to calculate in my head how fast do I make it up so I stay out, ahead in the green. And of course, when you're buying moves of 1,000 or 2,000 shares or even 500 shares, and you get a move from the 94 level up to within a matter of literally what was it, an hour, right? 2 hours, not an hour. What am I saying? By 6 o'clock, the stock was at 110. Now, most of my stuff was sold pretty much around this level, because by that time, to give you an example, whether one buys 200, whether buy 2,000, you're talking about a significant amount of money, which is well beyond what you played on the option side, on the other side. So is it always like that? No. But with a lot of these stocks, the initial sellout, right, like this initial sellout. So what happened was, let me finish. So what happened was that the points that I made off this trade here, which is pretty humongous, from for 6 almost 12 to 14 points. All right, almost 12 to 14 points. Yeah, almost 12 to 14 points was a gift, and I never look at a gift horse in the mouth, and so I took out literally all of it at that point. So I'm feeling good because it doesn't matter what happened on the call side, on that side. Even though I was going to take a loss, I was already net in the green on that overall trade. So the overall trade was an arbitrage of playing the after hours trade and then whatever was out of my control, which was the calls on the front side. So that's one important thing. The second thing is for people to realize, and we are in earnings season, you'll see a lot of these, okay, is the fact that the stock, anytime you see a stock like Netflix or Priceline and stuff drop like this, you always have a 90% probability of a pure short-term bounce. Why? Because the people who shorted here, and rightfully so, got lucky. So they got lucky and they get 20, 30, 40 points in the big cap stock, 60 points right off the bat. With Amazon, it happens all the time. They immediately sell it because the machines always remember one thing about algos. Algos have certain keywords in there, okay? And the minute they see those words, boom, they sell. There's no thinking involved. You think a human sitting here doing this? No, it's the machines dumping 10,000 shares, let's say. And the after-hour market is liquid, but it's not as fluid. So they read some negative term in there saying, like the word maybe is a sell signal on algorithmic programs. Maybe. Because they might have said, maybe we see this happening. Algos love to see higher guidance. So they read, they're scanning these reports within 1,000th of a second before you can even blink. So this is what happens. So the initial move down, the human traders who shorted here, they're like, man, this is fantastic. Let me cover. I just scored. I've done it before on the short side. I'm not going to sit here look like an idiot thinking the stock's going to go down another 10. Yes, it can, but who cares? So the shorts cover, including the machines. So the machines just made 16 points here on this drop, right? Yeah, 16 points on the drop. So they're going to cover. It's a win-win. This is your short covering rally. So that short covering rally generally does not go and get even like it did. It normally comes as a 50% retracement of any major drop, especially in the big cap stocks. So if it's a 50% retracement in a major drop, you can go out there, buy a couple of hundred shares. You can buy 100 shares. You can buy 1,000 shares. You can buy 2,000 shares. And you have to be glued to the screen, like your eyeballs can't even move, because the minute it falls below these lines, and it's going like this at that time, right? But I'm just watching these bars. I simply watch candles after hours in order to make money. I've done this way too many times. So that's the simplest way in reality how I did this trade.
So you use 5-minute candles basically for 3 minutes?
After yeah, absolutely, sir.
Okay.
You got to use 3 or 5 minute candles. There is no intermediate candle. You watch an hour candle, you're not going to even go anywhere, because to me, I want to get out and make quick money on this picture. Okay, so I want to make quick money, and if the only way I can quick money is after look, when this candle came, I sold a bunch. It's not that I bought all of it here and then sold all of it here. I sold this candle here. You sell a bunch. You sell a bunch. You leave it there.
No, actually, I think when Netflix results came, right, like it shot up a little bit, like if you could see, right, at the very
it shot up to 112. And the next second, when they read,
I shorted a little bit, but I think I didn't stick with the whole trade. Yeah,
I know, but listen, the whole trade didn't mean that I expected it to go to 93. You know what I'm saying? So another way I do it is whatever the amount of shares, because I buy common too. One of the best ways to pay earnings, is to buy a couple of $100. So sorry, couple of 100 shares of that common. So if it's an Amazon and stuff, let's say you buy 100 shares, 200 shares, whatever the case may be, whatever one wants to buy. I love it because what it does is it allows me to act immediately in the after hours. If it's up 20 points, bang, sell it out. Buy 200 shares. You just made $4,000. I mean, it's not a joke. In 3 minutes. If it falls $20, you hold tight. You watch what goes on. You might need to average cost down, or you say, you know what? I'm taking my losses right there and then. So playing common, even small amounts, 50 shares, 60 shares. I don't care. Like if somebody wants to make 10 shares, and the stock moves 40 points, you just made yourself $400 in 2 minutes. And if it completely
makes you glued to the computer basically.
Absolutely. And you know what? It's fun. Because the thing is, there is no way I can give commentary in after hours trades because they're such fast moving trades. The only way I do it is when I set up the live trading screens, then you can actually see and I can actually point out, because the live trading screens, once I set it up, is going to be complete audio too. So I'm going to be talking along the way, and I can immediately transmit the data and my feelings on what's going on immediately, and somebody can act on it right away. Look, somebody who's not who's new to this type of thing, they might not understand the power of a reversal candle. And the fact that you have a 50% retracement. This is, by the way, an exact 50% retracement between 102 and 103. And then that's the sell point. So those things, I can transmit rather quickly, but that's what I do. When I saw this and it wasn't breaking, and I my hand is on the trigger just to go boom out, and then it did that. I was like, this is fantastic. At that point, I honestly thought the stock was looking to go to about 114 or so. It was a total breakout, but then it hit this and it did that reversal candle, and like I said, I wasn't around at 110. But once I saw this, I said, man, I got 2 of these fat candles. 3, I'm not going to look at a gift horse in the mouth, because these are where they push the shorts hard. There, these ones, right there.
Yeah.
Okay. So once you see one of these burps, it goes like this: small candle, boom. Then you want to be selling into the spike. And it could have gone like this, for all I know. It could have gone like that, but who cares? I already made my money. So you'll be seeing a lot of these, by the way, after hours, coming up next week, and especially early November, when a lot of the big tech stocks, are trading. Biotech stocks do the same thing. So that's it.
When is the live trading going live?
I'm working on it, so I want to make it seamless. You know what I'm saying? And it's going to be a different level of subscription. It won't be the same thing as just, being a gold or platinum member. So I want to make sure that I do it properly so that I'm going to do beta testing with a bunch of people too. So I'm going to first do a beta testing, see if it's benefiting people, because I don't want to, look, there are live trading services out there which charge $500, $600, $700 a month. Okay? Because it's live trading is heavy duty business. Because it's not like you're going to see my trades, but you're going to see trades, at what point trades are going in, and you can really react immediately to things that your brain might not process immediately when you're looking at one of my charts on Twitter. You get it? So it's a very advanced level of thing, because you actually see at what inflection points immediately before my hands can even say send, on the thing. So okay. I'm going to have to refine a little bit, and I'm trying to see if I can get it done by next week or so. Okay, guys. Anyone have any other quick questions? No? All right. So listen, this will be, I'll have this fully uploaded and stuff by tomorrow. And I look forward to seeing all of you. And like I said, it's 2 hours this session. So it's not like, when people say, hey, I don't want to do this stuff, I say, listen, for 2 hours, you're getting some really valuable information, interactive inputs from good members, and this is worth it. So tell everybody to come and join us, and, it certainly is a benefit. Okay, so that's all for now. Thank you for listening. I'll see you guys tomorrow morning.
Thanks, man. Thanks for taking time.
Thank you, Klo.
I appreciate it.
No problem, man. No problem. Thank you. Bye-bye.